Despite attempts from central banks to tame inflation, our next guest expects continued volatility in the rates markets. Joining us is DoubleLine's Deputy CIO, Jeff Sherman. And it's also oil prices and natural gas prices, Jeff, that are down pretty sharply from their recent highs. We've been faked out before, but do you think we've seen peak inflation?
Yeah, it really doesn't look like we've seen the absolute peak in inflation. Everybody was talking about that last month, and we got surprised by the last print. But if you go to I believe it's the Cleveland Fed that puts out a real-time indicator of estimated inflation. And if you look at their forecast for the next month's inflation, it's forecasted using these kind of real-time indicators that you mentioned to be almost another 1% month-over-month growth rate. And so that would put us at nearly the highest levels we've seen in this part of the cycle. So unfortunately, it doesn't look like it's behind us. But what you've seen from a lot of the markets is that what you're seeing is that the inflation isn't just this U.S. phenomenon. We've been talking about this all year. This is a global phenomenon. The things you mentioned are commodity prices, things that are consumed by the entire global economy. We're talking about energy prices, which are inputs to everything. And then lastly, the supply chain issues. And so what you find here is that the market is reacting very negatively every time we get an inflation print. Bond yields tend to spike. The Fed comes with this reaction function that they're going to be on top of it. They're going to raise rates considerably and quickly. And then all of a sudden now there's fears of a recession. So it's a very reflexive thing that's going on in the marketplace right now.
Well, it's like one day we worry about inflation and higher rates, and the next day we worry about recession. And it's every day it feels. Today's a recessionary kind of day where the cyclicals are getting hit. And we're seeing this strength in treasuries, Jeff, which I wanted to mention because the 2-year yield today went below 3%. It was the first time we've seen that since early June. What are you guys at DoubleLine doing? Do you think that rates have peaked?
No, I don't think rates have necessarily peaked at this point. As you mentioned, it's when we get inflation data during a week, we get this sell-off in yields. And then all of a sudden we get kind of a low amount of economic data this week. We got some PMI data that essentially the manufacturing and service sectors are slowing down, but they still are somewhat in expansionary territory. And this goes across the globe. So what you're seeing is a very highly correlated market across just the entire sovereign yield space. And really this repricing the 2-year, what it's done now is it's saying, okay, the Fed is going to be aggressive. They're going to get to their planned hikes. But then at some point, either late next year or in early 24, they're going to be cutting rates again. So the market is having these neuroses of that all of a sudden the Fed is going to be forced into this hiking regime. And what that's going to do is cause us to have higher rates. And therefore, we get this elevated recession risk.